Everyone, and welcome back to Leah's Lifestyle. We're at it again in book club with Payback Time by Phill. We're on chapter 4 today. So, without further ado, let's just get through it. I hope you guys have your books, been taking notes, and trying out some of the things. So, this chapter is Payback Time means no fear. On page 1, I started my notes with what to stockpile is the harder question than when. There's not many or any perfect businesses. There won't be thousands of wonderful businesses that you will understand to stockpile them. Once you find the right business, it's easy to stockpile. Buying shares when they are on sale. Buying on sale is called buying with a margin of safety, MOS. 3 most important words in rule number 1 investing. Finding a big MOS to know the value of business you buy, then wait to buy it until the market drops the price a lot lower than the value. Just before the market drops 14K to 7K doesn't mean everything that went down is suddenly on sale. Companies can still be overpriced even when a market is in the middle of a meltdown, because meltdowns don't always mean like certain companies will drop, right? It really depends. Think of buying stock like buying a car. You can buy a Maserati and get a super deal or get cheated. Page 2. You have to wonder, are you asking the right questions? Like buying a car. Are the fundamentals good? Are the drivetrain in good shape? Is the body rusted out? Same thing with businesses. You got to figure out what those questions are so you know that it's a good company. If you get those kind of questions answered correctly, you can put a value on it. There are specific problems to consider as well. Cracked windshields, dings, torn seat covers, bad tires, bad radio. But you can put a solid cost estimate on those cosmetic problems, adjust the cost, and still get a good deal. If the fundamentals are bad, however, the potential cost to you from the car might be much worse than you can ever sell it in the future. Buying fundamentally unsound cars at any price, you lose. Same thing with comparatively a fundamentally unsound business. No matter the price, you can lose. So, get a fundamentally sound car or business, right, on sale, and you can make money in days. This is the foundation of knowing how to arrive at value in stockpiling for investors. Then he offers a book here called Irrational Exuberance, which I think we've read in other books, so it's probably on the list, but I wrote it down anyways. It's by Robert Schiller, and we will be reading that in the future. Emotions often determine the price in the market, resulting in pricing that are often far lower or higher than value. Price is what you pay. Value is what you get. Don't let anyone tell you that you can't get 0% return for 20 years by buying and holding the S&P 500. If you buy when the index has a high PE ratio, it's not only possible to get bad returns for 20 years, it's likely. On page 3, we continue. The PE is a ratio of price to earnings. Price per share divided by earnings per share, sometimes referred to as multiple, because it shows how much investors are willing to pay for each dollar of earnings. If a company has a PE of 10, that means an investor is willing to pay $10 for every dollar of earning. Page 4, we continue. If you buy and hold when the S&P 500 index PE ratio is low, your chance of a good return are excellent. From 1970 to 1985, several years when the PE on the S&P 500 hit below 8. Those years mostly yielded a 20-year return for 10% or better. Dr. Schiller's research teaches us if you intend to buy and hold for long periods of time, you better do your buying when prices are low, end quote. Mutual fund investors in 1990s and early 2000s bought it when the PE ratios were soaring. Now they are going nowhere, and compounded returns are dropping to 0. If you can buy at the right time and change 0% return to 20 years to 12%, imagine what you can do if you buy separate stocks like Mr. Buffett making 24% compounded rate. You wonder how do you figure out the value of a business you want to stockpile? Not how much you would be investing in those companies or how many companies should aim to have in your portfolio. Page 5. Check out his website. He offers in this book, it's called paybacktime.com, but I've adjusted it so every time when I say go check out his website, this is what I'm referring to, which is the rule1investing.com. And it's rule1000ONE investing.com. And specifically, I'm telling you this because I don't think the Payback Time webpage is up anymore, and that he's transitioned everything into this one webpage, so you can find everything that we'll be talking about there. So just so you guys know. For examples of finding the value of business. Remember, price and value are two entirely different things. Professional investors are under pressure to perform quarter to quarter and can't take the long view and focus on long-term values. They only focus on short-term because that's what their practice encourages them to do. Page 6. They have to focus on the price today. They would lose their job if they focused on long-term value while the price goes down, so the information is not worth anything to them. Rule number 1, stockpilers: know price alone is not what will make us lots of money, since we are focused on long-term value buying $10 for $5 and not being upset if the goes down to $3, but excited to buy it cheaper. And I think he talks a little bit more about this in page 7, but I just want to go over with you guys. If you're buying from somebody who, if you're buying stock through a third person, right, the stockbrokers and whatnot, you, outside of fees that we've talked about in the last chapter, they have a very particular way that they need their profiles to look like to be able to achieve getting raises and getting the year-end bonuses. And so if their profile goes down, they're not going to get those. So they will leave a good value business in the dust to get a very overpriced, not great business. So that is what he's talking about there, is when they could lose a job, right? So if they stay with good businesses, even though the price is dropping, they could lose their job because their portfolio would look very terrible. Page 7, finding the sticker price. Wall Street uses many names like intrinsic value, retail, what it's worth as a business. We call it sticker price. Like what a car you could buy is placed on the window. We never buy sticker price, just like a car. You'd want to get them lower than it, right? Or you try at least. Rule number 1, calculated sticker price with 4 key numbers. Earning per share, EPS, for the last 12 months. You can find this online, called trailing 12 months TTM EPS. 2, EPS growth rates for the next 10 years. 3, price to earning, PE ratio in 10 years. And the PE ratios over 10 years and divided by how many years, preferably 10. Minimum acceptable rate of return, MARR. It's fixed 15%. Why? Minimum acceptable rate of return, high enough to return to cover hidden costs of inflation, bond rates, and taxes, and still give us a return that justifies the effort. He has an Excel formula that he's called VF, future value, to use the 4 numbers to get the value of your business. Page 8. The reason stocks always sell at multiple of earnings is that no one would sell a business for 1 times the earnings. If you have a lemonade stand that makes $100 a year, you wouldn't sell it for $100, maybe $300, since it would take you 3 years to make that. Equals the multiple that you would sell it for is 3. Also, say the stand sold for a PE, price divided by earnings, of 3, or 3 times earnings. Page 9. You can find a PE over time on MSN Under financial results, menu item, key ratios, price ratios. Follow that, like those links, right? So from financial results, menu items, the key ratios, the price ratios. Look at the high and low average PE for the business for the last 5 years. Click 10-year summary. You will see the PE ratio each year for the last 9 to 10 years. Another way to find PE or multiple to use a double the estimate future growth rate. Find the professional analysis average estimate of future growth rates of earnings by clicking earnings estimate, clicking earnings growth rate tabs. If the estimated growth rate is 13% per year, then PE of 26 is the ballpark. 13 times 2 equals 26. Use the low figure of these two methods. Be conservative. So once you find these two ways of finding it, then you just pick the lower one, and that is your PE that you'll be using. Page 10. EPS growth rate for the next 10 years is central to knowing what to pay for today. The value of business is more dependent on the future earnings than what is currently holds in cash in hand, real estate, or net equity. Figuring out a reasonable growth rate for your target business depends on knowing the industry and the business very well. You cannot bypass the first 3 M's and calculate MOS and expect a return of 24%. If you haven't checked out meaning, moat, and management, it's impossible to arrive at the true value of business. Page 11. Our only reasons to bail out are if the business is no longer wonderful, and if the price is so high, we can't refuse the opportunity to cash out. He talks a little bit more about this a little later on, but I just want to insert one of the reasons you sell at such a high price is because of a bubble and to get your money back, so you're only playing with house money. But we'll talk about that more later. Continuing, don't get out because the price is going down. Take advantage of price drops to increase our compounded rate of return. But for stockpiling means we need to be a great deal more certain about the value of business than we need to be if we're trading, meaning we need to be a lot more certain about growth rate of future earnings. Why not just trade? Because of the way the market is right now. Because the technical tools of a trading strategy aren't free. There's a price to be paid for using them. Like insurance policies, they protect us, but they do at a cost. 3 reasons it's called trading friction. Even the best traders aren't always going to get out of the top and get in at the bottom. Sometimes you miss the big jumps or get caught in the big drops. Page 12. Trading games minimize our short-term losses, but the friction cuts into our rate of return. A good job trading can make you 15% return. Stockpiling, knowing a business is going up over the long run, will make you more money. It limits the friction of trading and accelerates the compounded rate of return by lowering your overall cost of acquiring the business highest returns as a novice. Companies with monopoly, companies that'll be around for the next 50 years or longer, are going to see their profits dry up and their businesses shrink. They will be offered to us at increasingly better prices. Nothing will change long term, but the short term look is and creates fear. Stockpiling is a wonderful business as it drops in price, sets you up for a huge return when the price returns to the company's proper value. Stockpiling guaranteed wealth and easy money. Tuck of traders is I don't know why it says tuck. I started typing so that way I wouldn't have as many errors for this, but I think this is auto-corrected. Tuck of traders. I think it's supposed to say, like, the negatives for traders is nirvana for us. Like, the positive things that we get out of the way we're doing it is, like, the bad stuff for traders. Like, they don't want to deal with those things. All it requires is nailing down the 3 growth rates. Nailing the future growth rates. 2007 to 2008, Warren Buffett bought $6 billion of Burlington Northern Railroad. And from here on out, I took the notes from this, but I kind of removed Burlington Northern out of it because I figured it would be easier for everyone to understand what he was talking about if I removed Burlington, so that way you can apply it to any company. So I hope it helps. Let's see how we go. Continuing on page 13. You need 10% or better for these numbers for many years. Return on investment capital, which is the most important number, tells us how the company is doing at investing the money it's getting from investors and from borrowing. Sales growth rate, earnings growth rate, equity growth rate, and cash growing rate and debt. Page 14. Secondary indication of which way ROIC will go is return on equity, ROE. Think of ROE as return of capital, younger's brother, same family, but ROE isn't quite as grown as ROIC. ROE is calculated without considering borrowed money, debt. Page 15. There's one time when it's fair to buy a business with low ROC. If whatever they spend their borrowed money on is about to produce a good ROC, you need the understanding of the business well enough to know if what they put their debt into is going to take a few years to see the return, or if they are buying companies to fund acquisitions that produce zero value to the investor, or if they're buying a new airplane, right, and going on yachts and spending all that extra. Essentially, here for a little bit, he's really just going to nail in, like, you really need to understand the company. You really need to understand the industry. If you don't really understand those, which is why we talked about the 3 circles of competence, right, creating our circle of competence, is because if you don't, then you could buy into a company where you're like, oh, this debt went to that, and I think that debt is eventually going to pay back and the ROIC will come up. And then you'll find out that debt didn't go to what you thought it was, isn't doing what you thought it was, and now ROC is going down, and so you're never going to make your money back, right? It's a possibility, a higher possibility. So make sure whatever companies you're buying into, if you're buying into tech, you better be a tech bro. You better be a tech sister. You better be in the industry, had gone to school for it, been around it your whole life. Because if you're not, then you could buy into a company that you have no idea why it's going up and why their debt's in a certain area and if it's going to help them or not, right? If you don't know anything about AI and you buy into all the new AI stuff, are you certain that all the money that they're building into the buildings and the chips and everything is going to make their money come back? Do you know it that well that you're for sure about that? Because if you don't, then you have just increased your likelihood that the company you're buying into will go down in the future instead of up. Okay? Any company can crash, so you need to understand why. Page 16. If you're going to let a low ROIC slide because of ROE, it is big. You had better know why the ROIC is low. The second most important number to examine is the equity growth rate, or book value per share, BVPS growth rate. Book value grows from earnings that don't have to be spent maintaining the business. Its rate of growth is ultimately reflected in the rate of growth of the stock price, since the stock price will increase with the growth of real owner value. Page 17. Growth is calculated from the starting point year that isn't counted as a year in the calculations. You have to have a baseline. If there are 10 years of data, there are 9 years of growth data. Check pages 72 of Rule of 72 in the book. Check that page. And go over Rule 72, which we did the last one. You do not then you don't need to run 10, 7, 5, 3, 1 years of analysis. Check on the 5-year chunks first, because it's not so important what's happening in 1 year. You can do the numbers if you want, but you will see it. Check to see if it's growing consistently over the years, even if it's not at 10% like desired consistently. In the past is the best sign. Oh, I should have put a period there. Okay, yeah, so just make sure that it's growing even if it's not the 10%, consistency is more important because it's more likely that it will be consistent in the future if it's been consistent, even if it's not at that 10% rate. Then check the 10-year summary of financial statements. How fast is sales accelerating over the last 5 years, 10 years? You can use his calculator on his website. Like we said, Rule 1, like the rule1investing.com. Check EPS, long-term rates of growth in the last 5 years. Check cash flow, the last 5 years remaining, remembering the first year is 0. Page 18. Check debt by looking at the balance sheet. Page 19. Make sure debt can be paid off in 3 years of net earnings. You might need to add up the last 4 quarterly earnings, net income, then divide by debt. If you stockpile with a company if you stockpile with a company that can't, you should know it well enough to know why and have it be a good reason where they will make more to be able to do it in the future. If they don't, it's a red flag and no free pass. You don't buy the business. So essentially, learn the business, learn the industry, learn. It needs to become your everything. Summary. ROIC is low so this is where he's talking about BNSF, right? And for BNSF during this time, ROC was low due to investing costs and ROE is high, which is a red flag. BVPS growth rates is consistent and below 10%. That's a red flag. Sales growth rate is recently consistent and over 10%, which is excellent. AEPS, I think that was a edit. Because it should be. I think it's just EPS. Yeah. Fixed. EPS growth rate is recently consistent above 10%. Excellent. Cash growth rate is consistent and 10%. Good. Debt is payable in 4 years from earnings. Bad, but maybe for a good reason. Page 20. If the big 5 look mixed, don't forget how important moat is in stockpiling. The big 5 cannot predict a great investment even when they're perfect. It's only an image of the past, and many businesses have crashed with great big 5 numbers. Big 5 can point us in the right direction with a business that has a good 3 M's, especially moat. Means you really need to understand the future of the business. Test to see if your business has a big moat. If you were given $1 billion to compete with them, would you be able to? Could you open up a business of equal value? And if not, why? Page 21. Sometimes the business won't be wonderful short term, but it will be wonderful long term. And you need to understand the business to know that. Plugging in the numbers to calculate value, the sticker price. Calculating. Look at the growth rate. Moving on to page 22 to continue. Look at what the analysis consensus of growth is. Go to earnings estimate menu, click the 4th tab, earning growth rates. Take the lower of the 2 estimates, yours or the analysis consensus. Pick the PE ratio, a multiple of earnings that the company trades at. Go to financial results, key ratios, price ratios. Add them up and divide by 2. You can also look at the 10-year statement on MSN Money and see the average annual PE. Which do you use? For the big moat business, use an average high PE. The buyer is going to have to pay up to get the moat. That is going to make the multiple of earnings higher, so use a higher than average PE. As long as it doesn't go more than double the growth rate and it's not out of line with the historical highs. Continuing on page 23. Double your estimate growth rate. Choose the lower PE ratio. Find the TTM EPS on the company's report page. Pick a minimum acceptable rate of return, MARR. Summarize the 4 numbers, TTM EPS, growth rate, PE, MARR. Run the numbers through the calculator on his website and you get the sticker price, retail value. Calculate the margin of safety price. If you are just starting out, go 50% off retail. If you know the business, go no more than 80% off sticker price. Page 24, continued. Check today's price. Decision. Is it buyable now? And action. Finish reading everything you can about this industry and company, then stockpile whenever it drops below your buy price. Page 25. Practice your valuation over and over and over again until it becomes second nature. Find people who can critique them so you can get better. Then the better you get, the more accurate you're evaluating and the better price you can get to buy a wonderful business for. And I think this is a big thing. Remember that you're going to look at a bunch of companies. So you're going to get that practice in. The thing is remembering that the majority of the companies, like you said at the beginning, there's not that many wonderful companies and even less of the wonderful companies on sale. So just remember, you're going to get a lot of this practice. So don't be thinking, oh my gosh, how am I going to get all this practice? And how am I going to do it again? You're going to do it again. You're going to pick a whole bunch of businesses that you don't know anything about. You're going to find out the numbers do not add up. They're not a wonderful business, the moat and all that stuff. And you're going to have to put them into the too hard or not good businesses or whatever. So just think of it kind of like homework from high school, from college. Like, think about it like that. Like, but the difference is, as you're not trying to finish it to turn it in, you're just searching. You're doing the research. You're trying to find the one, the two, maybe if you're lucky 3 or 5. But you're going to go through a whole bunch of businesses that you think, you're like, oh, this is it. I know. I've already done it. I've already done like a handful of them where I'm like, ooh, I know this is the business. And I was like, nope. I was disappointed every time. And I have another handful of them that I'm going to be going through soon. So trust me, you will get the practice. Okay, let's continue. Page 26, the MOS, a margin of safety price, MOS, is 50% off the sticker price, the retail price you calculated. For newbies, stick with this as your MOS until you have done it for a while, when you can change to 80%. But you must be certain and confident in your ability to find the correct sticker price. MOS is your safety net. The more wiggle room you sacrifice by upping the MOS threshold, the more certain you need to be of the sticker price. Payback time. Playing with house money. Stockpiling means buying a company for the long term. We are not going to sell when the big guys get out. In fact, we're going to buy in. When it's so important to get MOS right, we want a second opinion. Second powerful way to arrive at the margin of safety price is, quote, how long before I get my money back, end quote, aka payback time. Payback time is just the time it would take you to get your investment back. Once you get all of your money out of the business, you have no risk and you are playing the game with house money. Then you don't worry about existing strategy. And so this is what I was talking about earlier that he didn't really mention in the beginning, is when you buy out, when there's a big bubble or when the price is really high, you do that to get your money that you put back in out. So that way you're only playing with the house money. So that way the only money you have in there is the money that they gave you because you put your money in and it grew. Page 27. Example. If you got a business for $5 million and it made $1 million a year with no growth, your payback time would be 5 years. Payback time isn't a super sophisticated analysis of earnings, capital requirements, and work capital. It's purely a mental exercise about getting your money back. Then he offers a book by Ben Graham, Security Analysis, which we're going to add and read in the future. Payback time has to be adjusted for growth earnings. If you sold a company with growth earnings instead of 5 years, if the earnings are growing 12%, it could take 3 years. Page 28. But these 5 years return is for private businesses. The public, and actually in the book it says like somewhere between like 5 to 10, 8 is average, for private businesses. The public S&P 500 companies is 13 to 15 years on payback time. That's almost double what that of the private businesses. Why do private buyers demand less time for payback? For private buyers, it may take a long time to find someone to rebuy it. So you need to get your money back sooner so you have a lower risk. Continue on page 29. The range of payback time for private businesses is from 3 to 10 years, with 8 years as the average for venture capital deals and about 6 years for smaller deals. Things are different when you buy public stock because your investment is liquid. Since it's actively traded, you can sell almost instantly. If you make a mistake or things start to take a turn for the worst, you can cut your losses and get out. Even the big guys, though they do it in chunks, a little bit different because they have a bunch more money in, right? Billions of dollars compared to us. You can see exactly how much the liquidity is worth by looking into those average PEs and payback times. Value of liquidity of public businesses gets translated on average into about double the price of the same business would fetch if sold privately. Payback time for public companies average 13 years, sometimes much more here because the buyers aren't really worried about how long it will take to get their money off the table. We can buy stock in a wonderful public business at a private business payback time price 10, then we're getting a heck of a margin of safety. So the goal is to bring down the payback time price so you get your money back much sooner than most people are even thinking about. Page 30. BNI's Birthing Northern, the train company, market cap payback time. Learning to look at a public business without adding in any value for liquidity. Evaluating a public business as if it were a private business and we are going to buy all of it. Using 20K for, in the book, it's like billions of dollars, right? So we brought down the size so it'd be a little more understandable. So we're using 20K to buy the company, and it's $52 per share. So $52 times 340, and we used million outstanding shares equals 17,680 million. Here's how to figure out how long it will take to get your money back out of earnings. Find the market cap for the company on the company report. 17,680 million. Find the last 12 months earning on the income statement. Add up for all quarters, which was 12,115 million, or look it up on company reports. Page 31 continues. Grow it forward at 12% for 10 years or until you get your investment back, whatever comes first. Add it up. In 5.5 years, you get your money back. Figuring out earnings growth through the years. Start with net earnings, 2,115 million if you buy today, 0 years. Grow by 12% in 1 year. So we put little dots over, so it's 0.12 times 2, because we're changing the million to smaller, right? So 0.12 times 2,115 equals 253.8. On page 32, we continue. Now do it again. Year 2. Same thing, 0.12 times, and then it's the 2,115 plus the 253, which is 2,368 equals 2,841.16. So you add the 2,368 plus the 284, and you get 2,652. And you keep doing that, and you keep doing that until you make your money back. And that will happen in about 5 years. You can do the math, you'll find it. It will surpass the market cap for the company, and you can stop there. There are free Excel spreadsheet templates and tools on his website, rule1investing.com. If we can buy a wonderful public business at a private equity price, then we are buying it at an attractive price. Payback time out 10 years or less is an attractive price. Less than 6 years, very attractive. Payback time is not literally the amount of time it would take to get your cash back. Money will be used in other ways, like paying off debt or investing it to make the business better, right? So, but it's an estimate. Then he offers another book, Aswath Damodaran. So we're going to check that one out. We don't do complex. We do simples. We don't do gray, we do black and white. If it's complex business or the value doesn't leap out at us, we don't know enough and we don't buy. Knowing the payback time price gets rid of fear. If you get rid of the fear of investing, you will buy when everyone else is not, when they're selling. That's how you get rich. Page 33. Why bother looking at payback time when you're not buying the whole thing? It gives perspective on price and can help us spot price bubbles that MOS might not catch. Price bubbles in public stock can get so crazy that sometimes the price bears no traditional relations to the stock value. Yahoo in 2000 was selling for $500 per share, market cap of $505 billion, earnings $47 million, PE ratio 11,478. Remember, PE is very close to how long it would take to get your money back, right? Assuming earnings growth is 36% to get your money back, it would take 16 years. Outside of the fact, no company has ever grew that fast for that long. If I did growth that fast, the earnings would be $300 billion. Exxon, 2008, had recorded earnings of $45 billion, and the whole U.S. stock targeted regularly that year added up to $300 billion. Continuing on page 34. Another way to think of the price you're paying for a business is to imagine that the earnings aren't going to grow at all. If the PE or multiple will be numbers of years to take to get your money back, PE of a non-growing business will be the same as the payback time. In Yahoo's case, in 2000, it would take 11,478 years to get your money back. That implies either an incredible expected rate of growth or earnings as a massive bubble in the price. But what if and this is a question he was given, so we're just going to go over the question he was asked from somebody and then he answers it. But what if? Isn't the big flaw if your analysis that your growth estimate is isn't the big flaw in your analysis that your growth estimate is always, in some sense, a guess based on exploration from historical data points or on professional analysis opinions? Don't all investors commit the sin of assuming consistent company behavior based on the false faith of homework? Page 35. How do we know that a company can't suddenly, for no reason, plummet? Then he offers a book here, which I completely forgot to mark. The Black Swan by Nassim Taleb. So the question essentially is, how can we be certain we're buying businesses that's not going to turn from a white swan to a black swan, be really good, and then just out of nowhere for no reason go really bad? Mr. Taleb would insist that even a great business can suddenly veer off the cliff for no rational reason. Munger and Buffett are so right often because they are intensely rational. Rational buyers insist on a great price, even with great numbers over the last 10 years. An irrational buyer not only is expecting nothing but good news forever, but he also could be paying a high price outside of the black swan. If no good news comes, he will lose money. If we are going to stockpile and still safely account for black swans, we are going to be buying with a big margin of safety. Valuation. Not just historical data points or analysis opinions, but also our own opinions, keeping our view firmly on the front window rather than the rear view window. Continuing on page 36. We only buy when the big guys are selling. To buy from fund managers as the stock price is going down requires level of confidence that only knowledge of the business can create. You have to know your stuff. Knowing your stuff means knowing the business well enough to be happy holding for 10 years, buying all of it at the first MOS price you get in at, knowing it well enough to know, short of total fraud, that you are getting a good price. And even fraud can be mostly avoided by investing only with a CEO you trust for good reason. Page 37. Does does the requirements to understand the business put too much responsibility on our shoulders? Some experts will say yes, so you won't invest on your own. It's like driving. We learn, we get better, we have teachers. Lots of people get killed and have accidents every day, but we drive anyways. The difference is you are going to learn and drive safely your investments, or let a drunk who doesn't have a license drive you and your investments. One will surely get you where you want to go, but the other is surely to crash. And I think that was, honestly, I love this analogy that he put in there because it's so true. Like, we do things that we know are dangerous, but we trust ourselves. We've learned enough. We've been taught by enough people that we're like, oh, I know that's right. And investing is the same way. The reason it's so scary, the reason why we want to pass it off to other people is because we don't feel like there's enough people to learn from. We don't feel like the people to learn from are doing it right. So I think it's a big thing that if you're going to do it, that you really learn, you really soak in the information, and you take the time to read multiple books, take the time to listen to multiple podcasts, do a lot of practice before you start putting your money into it. Continuing on page 38. In both cases, safety and avoiding the accident is all about not going faster than you can handle, staying out of bad situations, and pulling over if you aren't sure. Refuse to become giddy when Mr. Market gets manic, and stay rational when he's depressed. You will do okay. You won't never lose money because you won't especially in the beginning do everything right. If you start off slow and try to do it right, you can correct your mistake and learn from them, and then you will make money enough to cover the mistakes. Then we learn and make fewer mistakes, just like driving. For maximum payback, down is the new up. Even after you buy, unless you own all of it, you want the price to go down, the part you haven't bought yet, so you can get rich. Continue on page 39. Remember, our net worth is not about prices, not in the short term. It's about value. If prices go down and we buy, so our net worth can go up big time. No plan to cash out today or tomorrow. We are investing for years. We want the stock price of the company we buy to stay low so we can buy more. Some examples. If you buy a company for $20 a share, sell for a margin of safety at $10, payback time 10 to 8 years, you have $10K to invest and buy 1K shares. In 6 months, you have another $10K. You want to buy more, but now it's back up to $20 with a payback time of 13 years. Nothing has fundamentally changed, but the margin of safety and payback time is too long. That means you can't buy any more and you're priced out. At the end of 5 years, the price is still $20. And if you decide to sell, you doubled your money and make 15%. Versus exactly the same stock. But now, after that 6 months later, you instead of it being $20 back up to $20, you have your $10K again. This case, it has fallen to $5 per share and payback time of 5 years. So you get to buy 20K more shares. And another 6 months, you have another 10K to invest. And find the price is now $1 with a payback time of 2 years. Continue on page 40. We assume the business hasn't changed, so you buy 10K more shares. You now own 13K shares and have invested 30K. The average price you paid per share was $2.30. 5 years later, just like last time, it's selling for $20 per share. The difference in the first example, you doubled 10 to 20 and made 15% compounded return. And the second, you stockpiled and have 30K invested turned into 260K with a return of 54% per year. When down is up, remember, when does a drop in price make the profit go up? When you stockpile a great investment. Why this isn't dollar cost average. This is common to investing strategy at dollar cost average, DCA, but it's not. DCA means investing a fixed dollar amount at fixed intervals no matter what the price of given stock might be. Real quick, I thought it was funny reading this because I've heard of dollar cost average before and I didn't really look into it because I never thought about doing it, but I'm glad I didn't. I'm really glad I didn't. Page 41. Continued. Dollar cost average has been widely criticized as economics and academics' financial research as more of a marketing gimmick than a sound investment strategy. Studies have shown not meaningfully reduced risk compared to other strategies, even completely random ones. DCA is a refuge for scoundrels. They would tell you to keep buying as the price goes down without knowing the value of the business and just hope that it goes up later. In a bull market, this can turn out for them by keeping your DCA down, the overall cost of your stock position, but they just don't want to be blamed if you sell and make nothing. So DCA the wrong stock and you can throw good money after bad and lose it all. If you think it can't happen long term, think of the 1999 and to 2009 tech stock. If you DCA'd the Q index with 12K, you would have invested 120K on average price of $47. In 2009, the price was $27. That's $20 less, guys. You would have lost 43% after 10 years. If you could hold on long enough, you could eventually get a 0% rate of return. Someday could be a long way off while your retirement is decimated. Page 42. Think of stockpiling as DCA with a brain. It requires you to start buying the big margin of safety and a good payback time, then continue buying as long as the MOS and payback time hold. If price keeps going down, you buy even more. If it goes above MOS price or payback time gets too long, we don't buy. Last page, 43. Back to BNI. What's next? Once you buy a wonderful business and get price and a great price, what should you do from that point? Should you hope the price of it goes up or down? Maybe answer that question first. If you're going to be buying hamburgers for a long time in the future, do you want the price of hamburgers to go up or down? Answer, down. Takeaways and action times. Our homework. Besides reading Chapter 5 with the businesses you're looking at to see if they are overvalued, review the 10-year financial history, gauge their future earnings potential, and determine the sticker price. Buying investments at a significant MOS will protect your MARR when you eventually sell at or above retail value. Don't confuse price with value. Always determine the retail value of a business and never pay it. Calculate the MOS price by using the free stocking piling tools on his website, rule1investing.com. Determine the payback time to get your money back. It will help you find bubbles that the MOS may not catch. And that's it, guys. Don't forget to like, share, and subscribe. Hit that bell icon down below so you know every single time when I post. And leave a comment. What did you guys think about this? Did you learn anything new? Was this DCA something you've done before? Have you heard about it before? What do you think about it? And if you want to extra support me, don't forget to check out my links. I have donations down there and merch for you guys to look at if you would like it. Don't have to, but I'd appreciate it. Help me pay my bills, take care of my kittens, and make this a little bit better over time. Until next time, guys, please don't forget to read number 5 and come back and join me. Till then, bye.